Hello everybody and welcome to my finance and accounting education channel. My name is Alex Petrescu. We are going forward today with my mini series about personal finance. I call it a mini series because for sure I don't intend to make 6,000 episodes out of it. We spoke already about so many things in this series. First we started with how to build a personal budget using Excel and a bank statement. We talked then about how to get rid of your debt, how to move from debt into wealth, how to invest for beginners, investing $1,000 or euros, investing $10,000 or euros, so somehow ramping up the stakes and seeing how that impacts your or should impact your decision making once you have a little bit more money to invest. The previous episode, so the one before this one, we talked about how to invest in mutual funds or in the investment funds. We talked about exchange traded funds, non-exchange traded funds, and all sorts of other aspects that are related to investing in mutual funds. Today we are going to talk about how to invest in stocks or how to invest in shares market. Basically it's the same thing. I'm quite sure that for many people just having a bank deposit or even investing in bonds is quite boring. I'm not that sure about investing in mutual funds, so all this discussion about index funds, about ETFs and so on and so forth, if that is interesting or not for many people. What I'm sure about is though is that many of you are interested about the stocks market, so investing in shares, and this is why we are tackling this topic today. Let's just jump right in. You have more or less two groups of shares. Okay, there are many in-betweens, and yeah, this is not really straightforward, but you have either companies which are delivering high dividends or companies which are delivering growth, and also many in-betweens. Usually you have young companies which are developing, because they can be young companies but they will not develop that much in 5, 10 years or 20 years and so on and so forth. So being young, it's as a company is by no means quality or certainty that you will develop in the future, but the ones that are young and developing will tend to pay less dividend. Most of them don't pay any dividend, especially for example in technology. The large companies are not paying any dividends, and because they are not paying any dividends, they are reinvesting their profits. However, you are getting value growth, meaning that the growth of the share price is quite substantial on the market, because they also deliver, because of this reinvesting and developing new products, entering new markets and so on and so forth, or investing in marketing. It depends what is their specific strategy. They will also have, let's say, more and more market share. They will grow their turnover, so their revenues, also their earnings, so the net income, and potentially at some point they will turn also to dividend distribution. If they are not in this group of new companies which are developing very fast, they are in the other group from my point of view, which consists of companies which are like already older than 20, 30, 40, 50 years or even more, in industries that have been around for that such a long period, where the market shares are, let's say, a little bit more stable. Okay, they are still innovating, but the movements in the market are no longer that, the markets are not growing as well, their sales are also not growing with stellar numbers, with double digits and things like this, and they have a different, let's say, approach, meaning that they take their earnings, and a lot of them they are also distributing towards the shareholders as dividends. They might retain a smaller part for reinvesting, but not as much as the growing ones. However, for you, it should be a trade-off, meaning that you should look at the total growth of your investment, meaning, okay, for this year I got X percentage price increase for this share, and together with this dividend I got so much growth, so it shouldn't really matter that much. However, you should mind some of these situations. Companies that are distributing dividends that are higher than their earnings, something fishy might be going on there, or all their earnings. If they have competitors which are still retaining some profits and reinvesting, the companies which are distributing all their dividends, all their earnings as dividends, maybe they don't invest anything and they have absolutely no, let's say, they will not only that they will not grow in the future, but they will also start losing market share and they will be in worse competitive positions. But you need to look in the same sectors and to see how the competitors are behaving. Then, of course, how to pick stocks. Long story short, no matter how technical you are, no matter how much knowledge you have, how much you are into stocks valuation, how much you know about sectors and so on and so forth, you still have personal preferences and you should not try to go against them, or at least not 100%. And you probably have brands that you like, you probably have companies that you have heard about and you like their human resources policy, their corporate communication, their strategy, just as I have said, their brands, their products, etc. And probably that's the point where you will start. Even though maybe a company speaks to you more than another one, you should still look into the financials. So be sure that the company has a good revenue, potentially increasing if the revenue is increasing a little bit faster than the market size for that specific sector. That means that they are gaining market share and so on and so forth, that they have earnings positive, growing and so on and so forth. So this kind of fundamental financials research you should do anyhow. You should also look for trends. So the idea is to try to understand the world we are living in, what's going on, what are the next big things, how the technology is impacting our life, is our lifestyle changing. Yeah, so everything that's new and modern and has a potential to really, because being new and modern doesn't always guarantee that it will also be a success in the future, but something that really has the potential of catching roots and being, let's say, widespread and a common thing between many market participants and things like this. Also in this, while we are talking here about sectors and trends and things like this, you should also be aware that companies come in different sizes. So there are small companies, there are mid companies, large companies. So small caps comes from market capitalization. We will see later what is market capitalization exactly. And large caps, and some consider that the tech companies are super large caps, or the 5 or maybe let's say 6 large companies that they are in a category of their own: the Facebook, Amazon, Microsoft, Apple, Google, so Alphabet, and some people also put Netflix here. I wouldn't, but it's not really that important. Then we are talking about financial ratios. So fundamental financials are like the things that are going on in the balance sheet, in the P&L, and with the, let's say, with their cash flow of the companies. But you also have some financial ratios which you should take care. And when you are choosing your preferred company and your preferred stock, you should also look in things like earning per share. Of course, since the per share can have there are companies that have shares worth $100, companies that have shares worth $3,000. So it's not really relevant for comparing between various companies, not even within the same sector. But it can show you, for example, an earning per share which is growing steadily over several years for the same company, provided that the number of shares hasn't changed. Can be a good sign, for example. Then you have the dividend per share. It's the same thing. And it's worth comparing with earning per share, because it will show you this percentage of how much from the earnings you are getting as a dividend as an investor. And as usual, you should look if it's very, very low, so they are not really giving that much dividend if at least the price of that stock is growing. If it's very, very high, at least that the price of the stock is not going down. So, you know, this kind of reinvesting the profits, what they are actually doing, and also compared with the companies in the same sector. Because if you are taking the ratio between dividend per share and earning per share, then you can start comparing the companies as well, no matter what is the price of the share. Then you have this PE ratio, or forward PE ratio, is the price of one share divided by the earnings. Once we bring into discussion the price of the share, you can already start comparing the companies, because it will no longer be let's say stop. So it will no longer stop you from comparing the companies once you are taking money with money and you are comparing like this. Of course, there are companies that have lower PE ratios, the ones which we were talking earlier, that are in established industries, will have 8, 10, maybe 12 PE ratios or something like that. The ones which are developing, so they don't even have that much earnings at the beginning, but the people think that they will develop a lot and they will deliver a lot of earnings in the future, will buy the shares and increase the prices, and hence the PE ratios will be higher. However, a forward PE ratio which is let's say lower than the current PE ratio should be good, because that means that the earnings are increasing, the price is the same, but you are just comparing the current earnings per share with the future earnings per share, and that's always a good sign. Then you have the earnings dividend or dividend yield. So when you are comparing the earnings or the dividends, you are comparing with the value of the share. That's a classical, because it's just showing you if you are beating, for example, inflation rate, or if you are beating an interest rate on a deposit. If you have a dividend yield of 4% in an economy that it has a 2% inflation rate and 3%, let's say, bank deposits interest rate, that means you are doing well, because you are doing more. 4% is always bigger than 2 or 3%. Then you have let's say this price to sales ratio and forward price to sales ratio. Some people don't like it because it's comparing the total market value of the company with the total sales of a company, and they don't like it because it's not taking into consideration the capacity of the company to turn sales into profits. Because you as an investor, okay, the sales can be stellar and they can grow and things like this, but if the company is unable to operate profitable and to have earnings either to reinvest or to give you as a dividend, that it's a very bad thing. And especially if the company is an old one at the beginning, when the company is just developing, you can expect losses and things like this. And the idea is that this indicator, this ratio, price to sales, is not very large, but okay, it's the same thing. Maybe you can look for the same company, you can look at how it's developing and what is it showing you for the future and things like this. And of course, we have already spoken about the market capitalization. The market capitalization is the value of the company or the market, or the value of the issued equity on the market, meaning that you take the share price on the market and you multiply it with the number of shares that are circulating out there, and you get the market capitalization. So these are the financial ratios for which you should look, how they are relative to competitors in the same sector. Yeah, so there are many things which you can do with these ratios. Please do read a little bit more about them and try to understand how to interpret them and what they mean. Then probably one of the most important question is when to buy. The idea is very simple. If you are a long term, so you are not a short term investor, if you go long, and you think that a specific sector, a specific country, a specific industry, doesn't really matter, will do well because, and you have to fill in the blanks. You should not worry that much when you are exactly investing, because you are doing this investment for, let's say, for 10, 20, 30 years, and it doesn't really matter if at that exact point in time you are on a peak or after a serious drop and so on and so forth, because in 10, 20, 30 years the prices will grow anyway. If you have made your bet right and you have chosen the right company, the right industry, and so on and so forth. There are these two concepts which I'm always recommending. Is buy the dip. It's probably you have heard it. This is more stock specific, so it can happen that in certain circumstances and unless it's something which is fundamentally wrong about that company, fraud, so large scale fraud, competitive problems, and so on and so forth. It can be that just because of the sectors they are and the month we are and things like this, that the shares are just dropping, and that's your favorite moment to buy. But that is more specific to a certain company or to a certain sector maximum. Otherwise, you have what I call the buy the market crash, which is somehow easier, or should be easier, because then you no longer need to pick the stocks because everything will fall down. I can name from the top of my head at least 3 events which were quite recent. Would be the 2008-2010 financial crisis, the 2016 Brexit, more relevant for the European companies and especially for the ones in the UK, and the 2020 COVID pandemic, which also affected all the markets in the entire world. And I'm saying here to be continued because nobody knows what other crisis might come in the future. And when the markets are crashed, that's your best moment to buy. I have here 2 charts to simply illustrate this. You have the New York Stock Exchange Composite Index. You have this red, you have the green arrow, which is showing you that somehow over time the market is always growing. So on a longer horizon here we have at least between 2005, I think it's from earlier than 2005 till 2020, so 15 years, you see the clear growing trend. And you have here 2 points which are marked. You have somewhere before 2010, so I would say it's 2008, 2009, where you have this financial crisis. So that was a clear point where you could buy. You have also the 2020 point where you could also buy, because in around end February, March, towards the end of March, you had this crash because of the COVID pandemic. I have this FTSE 100, so that this is the London Stock Exchange, on which you can see the dip from the 2016 Brexit specifically. Okay, here you can also see the 2020 COVID, and you can see also the 2009 financial crisis dips, and also there was a dip after 2000 and things like this. So these are the moments where you can, even if you can leverage yourself, so you can get some credits to buy shares. These are the moments where I advise you to do so, provided that the interest rates are not that high. And usually, in order to sustain the economy, the interest rates will go into lower levels in the immediate period. So it's the best possible way to use debt from my point of view. Okay, other than let's say for opening your own business or for educating yourself. So for this kind of investments, leveraging yourself to buy shares or to buy assets is probably the best time to do it when you have these large market crashes. Then we talked about, let's say for the mutual funds, we didn't use an Excel spreadsheet, but we talked about this, how to use an Excel spreadsheet when we had not the previous but the one before episode of this mini series, and we said how to evaluate an investment. So that was a general, and I said that this spreadsheet with this structure should help you evaluate any kind of investment. And here is the exemplification for a stock that I have owned. I have sold. You don't need to sell it. The idea is that this is some sort of post-evaluation. Of course, you can do a pre-evaluation. The idea is that for a pre-valuation you have uncertainty because you will not know exactly. You can forecast the dividends. Maybe you can forecast. You have for shares you have the target price of a share. You know, the analysts are giving you a target price for shares, and the longer you want to stay in the investment, and you can somehow model this. If you are looking backwards, so doing a post evaluation, it's easier because you already know what happened. And even if you don't sell the share at a specific point, let's say you are now in 2021, you have acquired in the past some share and you don't intend to sell it, you can put in this model the current value, so the number of shares you have multiplied with the value of the shares. You can put it in this table and you can still see if you have done a good or a bad investment. In my case, it's very simple. It's an extension from the template that I have presented before, because that one was going till period 10 only. It's going till period 12. Actually, the years are 2010 till 2021. So just to simplify, but I'm just keeping the template to show you that it works either way. You have first you have the acquisition of shares. Those are 5,300. The first year of the acquisition. Then you have the positive cash flow 1 in period 9. That is, I sold a chunk of them, so not all of them, just a part of them. Then in the positive cash flow 2 in the period 12, you have, in my case, the sale of the rest of them, but it needs not necessarily be the sale of the rest of. So I have completely divested these shares, but it needs not to be this completely sale of shares. It can be the actual value in 2021, for example, or in period 12, as I have it here. Then you have on positive cash flow, and it's like, let's say, something which should be regular, but it wasn't really regular, and also the values are not, those are the dividends. They are in this case net of tax, so what I have actually received. You see that in period 3, in period 6 and in period 11 I got absolutely no dividends for these stocks, and the values are fluctuating between 30 in the period 5 and 200 in period 8. Then you have these one-time expenses, which are actually commissions for selling. I didn't pay any commission when I acquired them, but when I sold the shares I had to pay some commissions. So you see in period 9 there is a 39.3 and the 43.3 in period 12. Then we are, just as I have said when I presented this template, we are adding everything on columns. Then you have the discount factor of my choosing is here the inflation rate. It's the inflation rate in Austria. We are using euros here, but the inflation rate is somehow local. You see we are going from 1.9%, 3.3%, 2.4%, 2%, 1.7, 0.9, 0.9, 2.1, 2, 1.5 and 1.4. Then I'm compounding this, meaning that for the period 2 I'm taking the period 1 inflation, for period 3 I'm taking into consideration the inflation or the discount factor for periods 1 and 2, and so on and so forth. Basically, if you are going on period 12, it means that by the end of period 11, the compound inflation was 22%. Actually, it was a little bit more, but you cannot see because it's only one decimal point. It's 22% rounded, let's say. And then I'm discounting the cash flows for each period, meaning that I'm dividing the total cash flow from that period with the compound discount factor for that period. For 5,300, because I'm doing a net present value. Actually, it's a net past value from my point of view, because we are in 2000, so we are in period 12. But if I were to evaluate that the period 1, and I'm divided by this compound discount factor, then for example I'm divided 105 total cash flow from period 2, I'm divided by 1 plus 1.9%, so 101.9%, and I'm getting to 103, and so on and so forth. I'm also discounting this period 9. All the cash flows are discounted. For example, the net present value or the net past value of the period 12 cash flows, which were nominal 4,295.8. The real value is actually 3,520.8. after I'm discounting them with this 22%, and the net present value or the net past value at the period 1 would have been 1,476. It's a positive, that means that I have beaten this inflation rate, so somehow I have made a profit. It's the same thing with the net future value, meaning that I'm bringing all the past cash flows, so from period 1 to period 11 into period 12. Of course, the value it's positive, is 1,801. The idea is that if you take the 22% of 5,300, so the initial investment inflated with 22%, you will get, I think, 20% will be one. Actually, we can do that with a calculator. 5,300 times 1.22. So I should have gained 1,166. I actually gained 1,800. So it's clear that I have beaten the inflation rate. And this is not showing you exactly this template. I told you that this is not showing you the internal rate of return, which will actually give you the exact percentage how much you've gained. And in order to find out how the internal rate of return works, mathematically, how you can do it mathematically with formulas, how you can do it with goal seek in Excel, or using a formula in Excel, which is specially defined. You will need to, unfortunately, to access my course called Credits and Investments, and there you have all the clarifications about how to do that, and that will show you exactly, okay, I had accumulated 22% and I have actually made 30% or 40%, which is more, and then you can also see there how much was that per year on an average, and how much you have beaten the inflation, and so on and so forth. Then the conclusions, very important. Always remember the losses are possible, so past performance is no guarantee for future performance. Of course, you are looking at these charts and you see the New York Stock Exchange, the FTSE 100, you are looking at your specific share and you see their stellar growth in the past. That doesn't necessarily mean, and not always, in that it will continue like that in the future. Bad things can happen, so the idea is not to panic. Most of the people panic if they are checking the share prices every day and they see this fluctuation from one day to the other or within the day and things like this. Don't panic. If you panic, stop looking. It's the best advice that I can give you. Look once per week, look once per month, or don't even look at all. Although this never looking at all, it's not a very good one, because let's say after 1 year or 2 years, you need to know how is your investment actually doing and if you should keep your money invested in that or just divest. Also, remember, if you own a share, you haven't made a loss or a gain unless you have sold when it was you made a loss when you have sold it with the price which is lower than the acquisition price, or you've made a gain when you have sold it with a price which is higher than the acquisition price. Let's say you have Webull, you have Robinhood, you have eToro, you have your from your bank an application, you have other brokerages. It doesn't really matter what you have on your computer or on your mobile phone. This plus 20, minus 20, they are not real until you decide to sell. So the idea would be not to sell when you are in red and not to buy when you are in green, unless you expect that the development will continue. You can also buy when you are in green. Yeah, so don't panic, don't sell when the prices are dropping, and try not to buy when the prices are increasing if possible, unless you expect the prices to grow further. However, if you have a share and the price is dropping, try to understand why is that happening. The other day I was laughing because I saw another YouTuber which was saying tech companies, it doesn't really matter when they announce their quarter results, either the quarter results are positive or negative, the tech companies' prices are dropping. Yeah, and if that's a given, we don't know exactly why it's happening, what are the big investors thinking, what maybe they have automatic policies to drop the stocks after the earnings announcement and things like this. Try to understand why the prices are dropping, if it's a general crisis, if it's a crisis within the sector, if it's a crisis within that country, if it's a problem with your specific stock. And if you decide to divest after a price decrease, then at least you know that you have made an informed decision. And for this, you need to really keep yourself informed, read the articles about the companies you invested in all the time. What kind of new products they have, what kind of strategies, new CEOs, what kind of financials, anything, scandals, everything that you can put your hands on about your specific company or sector, or even you need to know what's going on in a specific country or region and so on and so forth. You need to keep yourself always informed. That would be it about investing in stocks. I hope my advices are really helpful for you. These kind of advices are designed for beginners, so if you came here with the expectation of me telling you exactly in which stocks to invest and things like this, I'm sorry, I didn't deliver. Yeah, this is, as I have said, it's called the basics of personal finance, so you are probably more advanced and you need different kind of advice than what I'm giving here. Remember how you can support me. Of course, you can hit the like button if you like the video that you just saw. Share it with somebody you think might be interested about it. Comment if you have something to add about the entire discussion, so to all the topics that I have tackled here. And most important, don't forget to subscribe, and because that's really helping me, and it will also help you stay keep up to date with my videos. You will never miss a video that I'm posting. You will always see if something new is coming from my channel. And also, you have under this video, you have several links. First of all, you can create a eToro account, and you can trade there without commission and fees. We talk about investing here. We talked specifically about shares in this video. No matter how often you are buying or selling shares, for example, not paying a commission, it's very beneficial because it's a saving, of course. Then you have two links from Amazon. You either like audibles or audiobooks. You can get two of them for free, or you like the Kindle program, so you like reading electronic books, very practical for traveling, small device, you can have a lot of books on it. Yeah, so if you prefer that alternative. And last but not least, let's say the most inconvenient for you would be this wish list, on which I have a lot of items which will potentially help me improve the quality of my videos. So hardware, software, better webcam, a light system for my apartment, a green screen, laptop to continue to do these videos even when I need to be somewhere else than in my apartment. Yeah, so software, latest version of Microsoft Office, some video editing software, and so on and so forth. Once again, my name is Alex Petrescu. I look forward to presenting to you next time. Thanks for watching me, and have a good day. Goodbye.